In this video, we will be highlighting the S Corporation compensation analysis strategy within Intuit Tax Advisor. So for those taxpayers who made an S Corporation election in a prior year, they can still reap tax saving benefits in the years moving forward. You just want to make sure that you are routinely reviewing the S Corporation qualifications and the reasonable compensation wage for the shareholder employee that's receiving a W-2 wage. Occasionally, advisors recommend an S Corp and then they fail to set up payroll for the shareholder, and that is a huge red flag. That S Corporation needs to pay a reasonable wage to the owner shareholder. So in this situation, we have our client Larry, who's been operating Larry's law firm as an S Corporation and paying out a W-2 wage to Larry. So we can see here, we have the S Corporation and then those wages here in the summary. And on the pre-strategy baseline, here we have the S Corporation, that net income coming through at $164,705. And then those wages that are paid to Larry from the law firm are at $72,500. And this is going to be the net taxable wages after any retirement contributions from Larry. And as a lawyer, as a law firm, that amount can fluctuate year over year, so it's important to make sure that we're planning for this and we know what that taxable income is going to be and that there is a reasonable wage being paid. So many firms are familiar with other business owners and then what constitutes reasonable compensation. If that's the case, great. And if not, and this is new to you, you might want to refer to a professional resource like RC Reports to help with some guidance in that area. But in this case, we want to be able to calculate tax savings year over year for this strategy as long as Larry continues to generate net income from this business. So if we navigate over to the Strategies tab, over on the left-hand side, we'll see the Insights. And if we scroll all the way down to S Corporation compensation analysis, we see it right here. This Insight's going to give us some clarity here. So, hey, we have Larry's law firm. There's a net income of $164,000, and they saved $15,000 from that S Corp election last year. And just calling out the owner's salary must be reviewed regularly to verify it meets the requirements for reasonable compensation as defined by the IRS. And just like all strategies, we have the strategy card if we click into this, which is going to go over overview of the strategy, any requirements and who it applies to. Research and considerations, which can take you to some third-party links to help with context around that strategy, how that strategy is being calculated, as well as the client materials, which is the educational third-party links around the strategy and any action items that would appear on the client report. But we'll go ahead and add this strategy here. So here we go. We have the S Corp compensation analysis strategy on for Larry's law firm. We have that $164,000 coming through that K1, which is not subject to SE tax coming through on something like a Schedule C. And we're generating about $15,000 of savings from that. If we want a little bit more detail, we can go to this 3 more lines and expand this out and give a little bit more detailed breakdown of the numbers that are going into this strategy. So this first line, we have that net income from the S Corporation, and then the applicable rates for this, which is going to be the Medicare and the Social Security, as well as the tax savings associated with that. The details on these gives a little bit more description for each one of these line items. So the taxpayer, who is now the employee of the S Corporation, is going to be liable for half of the payroll tax due, while the S Corporation will be liable for the other half. Payroll tax consists of the Medicare, which is that 2.9 that we just showed, and the wages paid to the taxpayer, and Social Security tax, which is 12.4% of the lesser of that $160,200 ceiling, and that's for 2023, or the wages paid to the taxpayer. So this line 2 here, that's that W-2 wage that was paid to Larry. And since you want to regularly evaluate the reasonable compensation amounts, right here is where you can make that adjustment. And if we need to increase or decrease that amount. So for an example, we'll bump this up $10,000 for those wages. And as we do that, we'll see how that affects that total savings, because that $10,000, since we're bumping the wages up, is subject to payroll taxes. So we see a little bit of a decrease there as we increase the wages for Larry's W-2. So now we have a total of $13,976 in tax savings as we apply this strategy. If we want to get rid of this detail, we can collapse that. And now let's jump to the review plan here. So on the review plan, we'll be able to see that S corporation income as well as the wages here. And if we take a look at this, it's going to show that increase in the wages that we just adjusted. So now it's at $82,500 for the wages that we're paying to W-2. If we wanted to change or adjust these numbers here, we have the ability to. And then if I scroll down to the S corporation, we show that net income of $164,705. And we're decreasing that by the $10,000 paid in wages. And we also see this here, which is going to be that employer payroll for those wages. So this is what would appear on the review plan. And if we go to the client report and go to the tax plan here, and we go down to more about your strategies, it's going to show that S corporation compensation analysis. We have a little bit of detail for the taxpayer, an overview of that strategy, some third-party links for some more context around the strategy. We have an action item here. We can add additional action items if we choose to do so. And then we're going to show the total savings for that strategy. So firms who lead with tax advisory will usually use this strategy annually to show the value of being in an S Corp and the recurring savings associated with it. And this strategy really becomes a part of your entity selection analysis. And that's also something that leading firms are doing on an annual basis. But firms who lead with tax planning, tax advisory, they're starting with proactive, recurring conversations with clients to really understand their goals, their challenges, and then recommend tax saving strategies and business coaching and accountability to help them reach those goals. And the purpose of Intuit Tax Advisor is to support those ongoing advisory conversations, as well as showcase your expertise as a trusted advisor.